Over the last few weeks, something has happened that rattled America's financial system in a way we have not seen in years. Americans are finding it harder to pay their debts as household debts rise over $18.3 trillion, and Trump's economic policies make things worse. But here is the big news. Two massive companies investors trusted, companies backed by big banks, companies with strong credit ratings, collapsed almost overnight. And I don't mean small-time businesses. These were billion-dollar corporations that looked perfectly healthy on paper. One even carried a AAA rating, the kind of rating that says, "This is the safest investment in the world." Yet both of them unraveled so quickly it left Wall Street in shock.
Well, a major North Texas-based subprime auto lender is going out of business.
Let me break this down for you. The first collapse was Tricolor Holdings, a subprime auto lender. A subprime auto lender is a company that gives car loans to people who have bad credit or very low credit scores. So, this company made its money by giving out car loans to risky borrowers and then packaging those loans into bonds called asset-backed securities. On paper, these bonds looked rock solid. Ratings agencies even stamped them with a AAA rating, telling investors there was virtually no risk. Billions of dollars flowed into Tricolor because everyone trusted the rating. And then in September, the unthinkable happened. Tricolor missed an interest payment. Just one payment missed, and suddenly nearly $2 billion in loans were at risk. Lenders panicked. Some started moving to seize cars tied to the loans. And now the Department of Justice is investigating Tricolor for fraud. Fraud. That means this wasn't just a business mistake. It could be something far worse. If a supposedly AAA-rated company can collapse this fast, what does that say about the whole financial system? Folks, what we are witnessing right now is the collapse of the U.S. financial system. It is breaking down in large chunks, and trillions of dollars, which directly affects you, is evaporating due to the current pressures and recklessness from Washington and desperation of corporations. In this video, I will be explaining what is going on, but make sure you are subscribed because you really do not want to miss any of my future analysis. Here is the bad news. America is drowning in debt, and the cracks are breaking wide open. The sudden collapse of Tricolor Holdings, a major auto lender, is not just one company going bankrupt. It's a warning of how fragile American financial lives have become. Families are buried in loans and bills, and the White House is doing nothing to stop the bleeding. Tricolor ran 65 dealerships across 6 states, mostly serving Spanish-speaking families who couldn't get loans from banks. These were working people who needed cars to survive. Now Tricolor has gone bankrupt, leaving billions in unpaid loans. Banks like JPMorgan and Fifth Third face hundreds of millions in losses. Wall Street will recover, but the families who trusted Tricolor will lose their cars, their money, and their credit. And this isn't happening in isolation. In 2024, more than 1.7 million cars were repossessed, the highest level in over a decade. Today, 6.6% of borrowers with poor credit are over 2 months late, while even people with good credit are falling behind. Young Americans are hit hardest. Nearly 8% of Gen Z borrowers are late on car loans, proof that staying afloat has become nearly impossible. The reason is simple. The cost of living is out of control. Researchers say Americans can no longer afford even a minimal standard of living. The average car now costs nearly $50,000. Loan rates are above 9% for new cars and 14% for used ones. Car insurance has jumped 19% in just 1 year. What once symbolized American freedom is now a debt trap, forcing families to choose between keeping their car or paying for food and rent. Instead of helping, the Trump White House is making things worse. His trade wars and tariffs push car prices even higher. His deregulation agenda allowed risky lenders like Tricolor to thrive. Now, as families lose their cars, the administration stays silent. There's no plan to ease debt, stop repossessions, or curb rising insurance costs. Wall Street will walk away bruised but safe. Big banks will find loopholes, bailouts, or ways to pass losses onto the public. But ordinary Americans? They'll lose their cars, their jobs, and their financial future. And just when people thought it couldn't get worse, another giant fell. First Brands Group, a major car parts supplier, once boasted nearly $1 billion in cash. Yet on September 29, 2025, it filed for bankruptcy with more than $10 billion in liabilities, much of it hidden through invoice-backed loans. Creditors are now facing catastrophic losses. First Brand's collapse is not just about one company, it's another warning. Household debt has already hit a record $18.4 trillion. Families are falling behind on cars, mortgages, and credit cards. Now even corporations they rely on are imploding under the same weight of unsustainable borrowing. What makes this worse is silence from the White House. Instead of tackling the credit crunch, the administration doubles down on tariffs and deregulation, policies that raise costs and let reckless borrowing go unchecked. If a giant backed by major banks can unravel this fast, how many more are hiding the same rotten foundations? And how long before the financial strain spirals into a nationwide collapse? Here's the part you need to understand. These companies were not supposed to fail. They had banks, ratings, and market dominance. Yet in weeks, they turned from stable to toxic. If it can happen to them, it can happen to anyone. And that's the real nightmare. The collapse of these two companies is not just about bad management or bad luck. They reveal cracks inside a much larger structure. The $1.5 trillion U.S. credit market built on asset-backed finance. This is the market that allows companies to borrow by packaging up loans, invoices, or other assets and selling them to investors. It's the system that turns things like car loans, credit card debt, aircraft leases, and even music royalties into tradable securities. For years, investors have seen these as safe, even boring. But now the market is being forced to ask, just how safe is it really? Let's look at Tricolor again. Investors believed that its car loan securities were stable. The loans were bundled, sliced, and stamped with the highest possible rating. Everyone assumed they were protected because the assets, the cars, had real value. But the missed payment exposed a hard truth. Ratings do not guarantee stability. Collateral can lose value quickly. And once confidence breaks, the entire structure starts to collapse. One investor told the Financial Times that Tricolor's collapse was one of the worst things ever seen in the asset-backed securities market. Think about that. A market worth more than $1 trillion, and this is being described as one of the worst events ever. Now look at First Brands. It was borrowing not through plain bank loans, but through layers of hidden financing tied to invoices. On the surface, this debt did not appear on its balance sheet. That made the company look healthier than it was. But once the real numbers came out, the illusion fell apart. This is not just a problem for First Brands. If invoice-backed lending can be used to hide billions in obligations, how many other companies are using the same trick? And how much debt is truly hidden in the system? The answer matters because asset-backed finance is everywhere. It has become a lifeline for companies, consumers, and investors. A single failure can trigger waves of panic, forcing lenders to tighten terms, investors to sell at losses, and companies to lose access to credit. That cycle can accelerate quickly, and right now, it looks like the cycle may have already started. If this market begins to unravel, the fallout could stretch far beyond two companies. We are talking about the potential destabilization of a $1.5 trillion structure that underpins large parts of the American economy. To understand how we reached this point, we need to look at who is doing the lending. After the 2008 financial crisis, big banks pulled back from risky loans. Regulators forced them to tighten standards, raise capital reserves, and avoid the worst kinds of lending. For a time, it looked like the system had learned its lesson. But demand for credit never went away. Companies still needed loans. Investors still wanted high yields. So into the gap stepped a new force: non-bank lenders and asset managers. Firms like Apollo and KKR began filling the void left by banks. They built complex structures that allowed companies to borrow and investors to earn attractive returns. The deals became more and more aggressive. In some cases, the risks were buried inside layers of financial engineering. Ratings agencies stamped these structures as safe. Investors chased the high yields, and everyone acted as if the risks had vanished. But the risks had not disappeared. They had simply been pushed into a different corner of the system, one less visible, less regulated, and more dangerous. But the government has its hands in this too. Donald Trump promised to put America first when he returned to the White House. But for millions of American households, his economic policies have made daily life more expensive, debt harder to escape, and financial survival nearly impossible. The country is already drowning in record debt, and Trump's actions have poured gasoline on the fire. Polls now show that Americans are pointing their accusations at Trump for the renewed difficulties. One of the biggest blows is his tariff war. Trump raised tariffs on imports from China, Mexico, and Europe, which has made everything from groceries to cars more expensive. Families can't keep up. High interest rates crush them, and now prices at the checkout are even higher. A gallon of milk, a used car, even school supplies cost more. This forces people to rely on credit cards, payday loans, and subprime auto loans just to get by. Debt piles up faster, but paychecks don't stretch further. At the same time, Trump's tax and banking policies reward corporations and the wealthy while squeezing the middle and working class. His administration loosened regulations on lenders, making it easier for predatory finance companies to trap borrowers with sky-high interest rates. Subprime auto lenders collapsed this year, leaving millions of Americans with repossessed cars and destroyed credit. Instead of cracking down on abusive lending, Trump looked the other way, protecting Wall Street banks that profited from the crisis. Healthcare and housing have become even bigger nightmares. Trump cut federal assistance programs and blocked debt relief measures that would have given households breathing room. Rents and mortgages are climbing, but government safety nets are weaker than ever. Meanwhile, his rollback of student loan protections means young Americans are once again chained to debts they cannot pay off. It's no surprise Americans are finding it harder to repay their loans under these policies. But the real danger is what comes next. If trillion-dollar giants can collapse overnight, what happens when the entire $1.5 trillion credit market starts to buckle? That's the question America now faces. Do you think the system can survive this pressure? Or are we already in the early stages of the next great financial crash? Share your thoughts in the comments, and don't forget to subscribe so you don't miss the next update.